Had to start investing from zero today, knowing everything I know now, this is exactly what I do, step by step. No hype, no gambling, no guessing which stock might explode next week. Just a simple, predictable plan that actually works. Even if you're starting small, even if the market looks expensive, and even if you've never invested before. Because here's the truth. Wealth isn't about timing the market, it's about time in the market. If you stay until the end, you'll see how I would personally grow $1,000 a month into hundreds of thousands of dollars, safely and predictably, all using boring, proven strategies that actually work. Before investing a single dollar, let's fix the mindset, because that's where most people fail. Everyone asks, what should I buy? But the better question is, how should I think? Investing isn't about getting rich fast, and it's about getting rich for sure. And that starts with understanding one thing. Your cash is quietly losing value every year. That $4 coffee from a few years ago? It's $7 now. That's inflation. The silent tax that eats your savings while you sleep. If your money isn't growing faster than prices rise, you're actually getting poorer. So, rule number one, don't let your money sit idle. Make it work consistently. The biggest wealth builders didn't guess the next hot stock. They invested every month through every crash and let time do the heavy lifting. Patience and consistency. Those two habits separate long-term investors from short-term speculators. Before investing, I'd build a strong foundation. I'd save about 3 months of expenses in a high-interest savings account. It's my cushion, so I never sell investments when life hits unexpectedly. Then I'd eliminate bad debt. Credit cards, payday loans, gone. You can't outinvest 20% interest. Paying that off is like earning a guaranteed 20% return. Next, I'd use the right accounts. In Canada, TFSA or RRSP. In the US, Roth IRA, 401k, or brokerage account. These tax-sheltered accounts multiply your returns over decades. If your employer matches contributions, take it. That's free money. Never leave it on the table. Once that's done, then you're ready to invest. If I were starting now, I wouldn't try to pick individual stocks. That's gambling with extra steps. Instead, I'd buy index funds, specifically broad market ETFs, that hold hundreds of companies in one single investment. When you buy an S&P 500 ETF, you automatically own pieces of Apple, Microsoft, Amazon, Google, Visa, Johnson & Johnson, and hundreds more. If one company fails, the others carry your portfolio forward. It's like betting on the entire economy instead of one horse in the race. Historically, the S&P 500 has returned about 10% per year on average, including every crash and recession. That means your money doubles roughly every 7 years without making any contributions. Start with $10,000. After 7 years, $20,000. After 14, $40,000. After 21, odd $80,000. After 28, $160,000. That's exponential growth. Your money becomes a snowball rolling downhill. Each year it gathers more and more momentum until it practically grows itself. Here's what I'd invest in. For US investors, VOO, Vanguard S&P 500, VTI, Vanguard Total Market, or SCHD, Schwab Dividend ETF. For Canadian investors, VFV, S&P 500 in CAD, XEQT or VEQT, Vanguard Global Equity. These hold hundreds or thousands of companies with management fees under 0.1%. Low fees matter. If you invested $10,000 for 30 years at 8%, paying 2% in fees would cost you almost $10,000, $250,000 at lost growth. With a 0.05% ETF fee, you keep almost everything. That's why even Warren Buffett says most people should just buy index funds, because over time, they outperform almost everyone who tries to beat the market. So my rules are simple. Diversify broadly, keep fees tiny. Hold long term. Boring? Absolutely, but boring builds wealth. Here's where most people fail: consistency. They buy when they feel confident and stop when markets drop. If I were starting now, I'd automate everything. Every paycheck, a fixed amount, $100, $300, or $500, automatically invested into my ETFs. No thinking, no second guessing, no temptation to spend it first. That's called paying yourself first. Think of it like a subscription to your future wealth, except you're the one getting richer every month. Automation removes emotion. When prices drop, your automatic buys actually pick up shares on sale. That's how long-term investors quietly outperform the emotional ones. Even $100 a month compounds into over $55,000 in 20 years at 8%. Double that, and you're on your way to changing your financial future. Let's talk real numbers. If you invest $500 per month and earn 8% annually, in 10 years you'll have around $91,000. In 20 years, around $295,000. In 30 years, about $745,000. If you invest $1,000 a month, that's roughly $1.5 million over 30 years. That's not luck, that's math. Your money earns money, then that money earns even more. Like a snowball that keeps rolling, faster and heavier with each passing year. The earlier you start, the more gravity works in your favor. If I were starting today, here's what I'd never do. Try to time the market. You'll miss the best growth days and destroy your returns. Buy high-fee mutual funds. They silently drain thousands from your future wealth. Panic sell in a crash. Every major crash in history has fully recovered. Follow social media hype. If everyone's talking about it, it's already too late. You don't have to outsmart the market. You just have to outlast it. Once my portfolio hit $50,000 or $100,000, I'd diversify a little further. Maybe add 10 to 20% in international ETFs for global exposure, 10% in bond ETFs for stability, and maybe a small slice in REITs for real estate exposure without buying property. But my foundation, 80 to 90%, would stay in broad, low-cost index funds. No complicated charts, no guessing games, just consistency, patience, and time. Here's the roadmap I'd follow if I started investing in 2025 or 2026. Build a small emergency fund. Pay off high-interest debt. Open a TFSA, RRSP, Roth IRA, or 401k. Buy broad, low-cost index funds like the S&P 500. Automate your contributions. Ignore market noise. Stay invested for decades. That's it. Simple, predictable, proven. Wealth doesn't come from being perfect. It comes from being consistent. So don't wait for the perfect time. Start small, start today, and let compounding take care of the rest. Because the best investment strategy is the one you actually stick to. If you found this helpful, hit that like button and subscribe for more simple, predictable wealth building videos. Check the description below for my recommended brokers and free compound interest calculator for both US and Canadian investors. Stay consistent, stay invested, and I'll see you in the next one. Remember, building wealth isn't about luck, it's about consistency.